Okay, we are online. We are live, and our speaker today is Ertan from Multiple Capital, and topic going to be about European VC ecosystem from an LP perspective. Word is yours. You're welcome.
Thank you. Thank you so much, Sergey. Yeah, I would like to speak today about what I call sustainable VC in Europe and what we need in Europe to have a sustainable VC ecosystem in Europe. So I'd like to speak also from an LP view and about Europe as a main continent or VC ecosystem. So I think what we need in Europe is mainly returns. Everyone, like every VC will agree to that if we speak to LPs and compare ourselves to US, everyone speaks about returns and that we need the IRRs, the TVPIs and the DPIs to show potential LPs to increase VC money in Europe and to have a more sustainable VC ecosystem. If you look at those two continents, US and Europe, we see that we had roughly almost 3 times the number of VC deals in US compared to Europe. So it's like, there seems to be a gap between US and Europe in terms of VC deals. If you look at the deal value in $1 billion, the gap seems to be bigger. So it's more like 3 to 4 times that the US is bigger than the European VC ecosystem. If you look at countries, we see that, for example, the US has deployed 86 billion, but compared to the country, or by country, the biggest second country is UK in Europe with only 8 billion. Germany followed with 4.5. But if you look at the next slide, which is VC funding per capita, we see that US is not the leading country anymore in the world. It's a country, tiny country called Israel, everyone knows. And Israel is per capita even has a higher deployment in VC compared to US. But then what's really interesting is in Europe, it's not UK or Germany, but it's Sweden, Finland, Denmark, before Germany, for example, and even Sweden and Ireland before UK in terms of VC per capita. So that's a very interesting data point, I think, when you look at the VC ecosystem in Europe. So where does the LP money really come from in Europe? We think it's mainly Europe. It's mainly government in Europe. So government, and we're talking here about the European Investment Fund and local government initiatives that put a lot of money into venture capital ecosystems. You don't have that in Israel, you don't have that in the US. So in numbers, it's roughly 30 to 49%, in some countries even up to 80% government money, but you still need the 50 to 70% private LP money to raise a fund in Europe. So when we look at the assets under management split of the largest pension funds, it's roughly 44% of pension fund money is in North America, and then 26 and 26% each is roughly split in Asia and Europe, and rest of the world is roughly 3%. Why are pension funds not investing in VC? It's mainly because of, we're talking about European VC mainly, it's mainly because of a long track record, returns, that's what I've mentioned in the beginning. It's regulatory issues, lack of competence, not moving the needle for a pension fund, and too big to invest. So the pension fund is too big to invest. And there's often a threshold that VCs know, and also other people in the industry know. There's this 100 million threshold. You need a 100 million funds to be able to raise money. Or I would say it's a 20, 10, 200 rule. What do I mean by that? The minimum ticket size for many pension funds or bigger institutionals is around 20 million or more. The maximum holding is most of the time 10% or lower, which equals to a minimum fund size of rather 200 million or much bigger than the 100 million threshold. So many funds need to be 200 million or even much bigger to be able to raise from pension funds. So that means the bigger the fund, the easier the fundraising. This is one of the first findings, I think, in Europe, which is also true for US, or if you look at the private equity industry, the bigger the fund, the longer the history, the easier the fundraising. Coming back to returns, and I said, returns are the main driver for a healthy ecosystem in venture capital. When you look at, and this is very generalized and very simple view, but if you look at the risk return profile, I think more or less everyone agrees that venture has a higher risk and therefore should have a higher return as well, followed by private equity, hedge funds, large cap equities, corporate bonds, and then money market fund, which is super low return, but also super low risk. And then there is the inheriting money, which has a super high return and low risk, or investing in a restaurant, which typically has a very high risk and low return. So let's look at the long-term IRRs of venture capital. So if we look at the long-term IRRs over the 25-year period, we see that the median venture capital IRRs over 25 period is 14.9%, or it's above NASDAQ and S&P 500. This is also true for a 20-year, 15-year, and 10-year period, interestingly. So we're talking about median. If you look at top quartile, the 25-year performance in venture capital is around 30%, 30.6%, which is 23.3% per year higher or over S&P 500. This is for every year the case. You look at a 20-year average, you look at a 15-year, 10-year, and 5-year returns. All of them have higher returns than S&P 500. But even median returns in venture, long-term, outbeat S&P 500 and NASDAQ. That's very interesting, I think, to know. So this is Palico key trends from 2017. They do this every year. But in 2017, I think this hasn't changed much over the last 1-2 years. The question is, LPs and GPs with a range of alternative asset managers say PE will outperform hedge funds. So 52% think private equity will outperform hedge funds. Okay. The interesting thing is, the next question is, the average buyout will earn at least 10% IRR annually. And only 41% think that private equity, the average buyout fund today, will have a 10% or better return in the future. And 59% of the participants, so LPs and GPs, think that private equity today, so made today, will not have a 10% or higher IRR. So if you look at, so that's not like, don't look at the details here, but just the graphs and compare them. On the left side, you have the PE IRRs, private equity IRRs, and on the right side, you have the VC IRRs. Just look at the trend that you have since 2001. So the trend in PE is more or less sideways, and the trend in VC is going up. So that's the comparison that I want to make here. I think venture capital just improved over the last 2 decades, in terms of returns compared to private equity. So what about the number of companies? I think the number of companies in venture is very important, because you have like a high risk in venture capital. So there is something that we call power law. So out of 1,000 startups, the average outcome is something like that. This is a post from Dave McClure, founder of 500 Startups. But we expect like 50 to 80% to fail or return less than 1x. We expect 15 to 25% returning 2 to 5x, which is like the private equity return today for single companies. We expect 5 to 10% have a good return of 10 to 20x, and we are expecting only 1 to 2% with a 50x outcome. So only 1 out of 100 companies will have a 50x or an amazing outcome in venture capital. So what is the average portfolio of an angel, for example? Just to, talking about the numbers again, the median for a US angel over a 10-year period is 7 investments, 7 companies in a portfolio. Mean is 11, 5-year average is 14, above 5-year, below 5-year is 7. So, and the lowest is 1 and the highest are above 100. So that's what I would call a super angel, like Brad Feld, for example. He posted in a post that he had made 75 angel investments. So even Brad Feld has only 75 angel investments. So how's the distribution of returns when you look at the number of companies? And here, I just want to talk about the green ones. If you have 100 or more, 200, 500 companies, the return, the the expected return is more or less similar and quite well compared to a smaller portfolio like 20 or 50, which most of the VCs have. So if you have 100 plus companies and you have the right selection, the probability of having a 3 to 4x, or even if you hit the top quartile, having a 5x return is quite high. I want to skip that and talk more about this. So when you look at, when you have a winner in your portfolio, you have 50 companies. If you lose your top company, it would mean, if you have a portfolio of 50 companies, that you would lose 49% of your portfolio value. If you do that same math for 100, 200, and 500 companies, you see that for 100 companies, you would lose, with your single best company, 36% of portfolio value. For the 200 companies, you would lose roughly 20%. And for the 500 companies, you would only lose 7% of your portfolio value. So what does it mean? If you have 500 companies in your portfolio and you lose your single best company, you're losing only 7% of the value of your overall portfolio. Whereas if you would have 50 companies in your portfolio and you lose your single best company, it's more like 50% of the value of your portfolio. I think this is an extraordinarily interesting data set to look at when investing in funds or in venture. What about the fund size? We talked, before we said the bigger the fund, the easier the fundraising. But fact is, the smaller the fund, historically, the better the returns. So we can say like 24% of small funds had a TVPI greater than 3x, okay? And versus only 7% of large funds. So the hit rate, if you invest into a small fund to have better returns, is much higher compared to investing in large funds. Everyone thinks that investing in large funds saves you of, I don't know, the bigger the fund, the more safe, etc. In venture, it's the complete opposite. The smaller the fund, typically the better the returns on average and the outcome. So this is a quote from Duncan Davidson, partner of Bullpen Capital. Improved technology and the advent of open source software has made it cheaper to launch a startup, which also means it's cheaper to fund one. So just saw a very good article of Mark Sasta, who said completely the same thing. 20 years ago, starting a tech company cost you 5 million. Today, you can start a tech company with 50K. That's a real big difference if you think about money you need to start or fuel a company in the beginning. It changes if it becomes a later stage company. You need more money today for later stages, and you need less money to start for seed stage, for example, or pre-seed. Another statistic, which is more about the last 15 years, 75% of funds with a multiple of 3x or more were smaller than 250 million. So 3 out of 4 funds with a 3x return were smaller than 250 million. And the range is between 10 and 250 million fund size. That's just the picture about the number of global unicorns. At the moment, we have roughly 400. I think today we have probably more than 400 tech companies valued at 1 billion or more. But the global average exit valuation is only around $100 million. So you need to make your return with $100 million exits on average. And here's another statistic from CB Insights. 80% of all tech exits, venture-backed tech exits, were below 200 million exit valuation. 2/3 were below 100, and more than 50% were below 50 million, and only 4% were unicorns. What we want to say is that the majority of tech exits are not unicorns. And if you want to make returns out of the majority of tech exits, you need smaller funds. Unless without smaller funds, you can't really have a real return on those smaller exits. So again, talking about the threshold that we have talked before, 20-200 rule and minimum fund size of 200 million. So that's the paradox. That leads to the paradox 1 of VC. The bigger the fund, the easier the fundraising, but the smaller the fund, the better the returns. I think this is a real paradox in venture. So the good news is family office and high net worth individuals invest in venture capital. Assets under management for German high net worth individuals is $350 billion. I want to skip that. We don't have time for that. Just here on the right side, I think it's very interesting. This is a data set from UBS about global family offices. We just saw an increase of 8,000 new family offices during the last decade. That's huge. So the challenges for VCs and LPs, the market is very fragmented. It's difficult to access gatekeepers. You see a lot. You have a lot of the LPs, like traditional big LPs, have a lack of competence in venture. Small investments tickets, you need small investments to participate in most of the funds that have the potential to return. There is not really a diversification in the market. Focus on local markets, so the local investors, LPs, mainly invest in local funds. Cyclical investing, especially today when we're talking about COVID, many LPs move out of venture, and 2 years or 1 year ago, everyone wanted to invest in venture, and direct investing, fee avoiding mentality during LPs. So that's a comparison. If you're a high net worth individual comparing yourself with a fund, with a VC fund, you typically have like 1 against 5 or 1 against 10 against the branding, etc. It's very difficult really to pitch for the best companies if you are have a setup like this. So how much should a family office invest in VC to afford an own team? Let's say you need a team of 5 to really be able to invest in early stage venture. That means, like roughly in Germany, you would probably need a budget of 500,000 a year, which if you would equal this to 2%, which is the standard management fee and funds, would equal to 25 million. So a family office investing in venture, building his own team, should invest at least 25 million into venture to justify the costs for the team. Most of them don't do that. Solution is we could invest in funds. And this is a very interesting statistic. It's about funds, the number of portfolio funds in a portfolio. And Professor Gottschalk is here talking about the ideal number of funds in a portfolio. And you see that if you have one single fund, you could have a 6x in return, but you could also lose all the money. Statistically, that's possible. If you have 5 funds in your portfolio, you still would get, or if you select the 5 worst funds, you would get less than 1x. If you have 10, the worst case would be above 1x. And 15 is like more or less the best combination of funds or number of funds, because if you do more than 15 funds, the returns come down. So the risk is not changing a lot, but the returns are coming down. The best probably is 100 funds, but most of the LPs, even in the LP world, would not be able to invest into 100 single funds. So diversification, number of funds, vintage, geography, stage, and sector thesis. I think that's like a very important thing in venture. And again here, like if you're investing in funds and you're comparing yourself with a fund of funds on the left side, again, one single person or one high net worth individual, I think, can't do the same thing as a team of 20 people in a fund of funds. So you have to ask your question, why should you be able to select a portfolio of 15 funds out of hundreds with only one person? And here the same thing, how much should a family office invest in VC funds to afford an own team? When we would say team of 2, which equals to 200K, just a simple, very simplistic view, 200K should equal to 1% management fee. That's the standard in fund of funds. That would again equal to 20 million. So if a family office plans to invest 20 million into venture, they could build their own fund of fund internally. That's like a super simplistic way. Everyone knows that 2 people is not a big team. And so that just for you to understand it. So paradox 2 of venture capital, in my view, is family office can invest in venture. Family office can invest more than 20 million. If this is negative, they probably can't afford real dedicated teams, which is negative. This leads to a bad selection diversification. And this leads, in my opinion, to lower returns. And we talked about returns, and that's what we need in the end to build really a sustainable VC ecosystem. So what is needed from VCs? Track record returns, build it long-term, strong thesis-driven funds, war for talent. We're winning the war for talent at the moment. We hope that this will continue. Ability to raise through cycles. So don't think in what I would say is in cyclical investing, and long-term LP base. So build a long-term LP base to put you through over very long-term period. What is needed from LPs? Increased allocation to venture, awareness of social and economic impact of venture. I think everyone talks about impact investing and climate investing. Just be aware that technology investing extremely early has not only the effect of returning money probably quite well, but also has a huge social and economic impact in a lot of economies like Europe, for example. Long-term investing, building competent teams internally if you want to invest, diversification and right setup. So just a few words about Multiple. We are a fund of fund focused on micro VCs in Europe. We are enabling diversified access to technology companies. We invest in multiple funds, multiple teams, multiple geographies, sectors, verticals, and vintages. That's it from me. Thank you very much for your time.
Yes, Ertan, thank you. Thank you. Very interesting. Very interesting. You know, I see a lot of people here. I don't see the question yet, but you know, on which market are you oriented? I see that you are being engaged in whole Europe, but actually just localize, please, somehow.
So I'm mainly Europe, like I'm mainly focused on European funds. I think that is, for me, one of the big advantages compared to a lot of fund of funds, for example, in the US. You have a lot of fund of funds already in the US, but we are one of the first fund of funds in Europe, and we are probably one of the only, or the only one of the very few focused on small funds. So we believe that small funds outperform in venture. And we believe that companies, it doesn't matter where you start the company, more or less, they become global companies. If you look at Spotify, started in Sweden, Skype started in the Baltics, TransferWise started in the Baltics. They're all European companies, but today global companies. Everyone knows them as global companies. And I think this trend will continue. For us, it's important to have access extremely early through funds, which are specialized in either markets, local markets, or vertical markets. And by that, building a portfolio of 500 companies, 500 tech companies out of Europe.
Okay, you know why I'm asking that question? Because when people looking for funds, they are, somehow opinion within the people around that the European market or European virtual funds are not via capital is not so huge. That's why all of them looking for American. I don't know why it's happened, because you're saying that European companies are treated as global. Maybe somehow you can explain for me that.
Every company that is successful today in technology becomes a global company. We have like 1/3 of the companies that we have backed in Europe do their next rounds in the US. So they become US investors, they get US investors, and most of them become a US company. So it's not about where the company early stage is based, because the company could be in Malaysia or in Israel or in Singapore. If the technology is right, or in Romania. I think the strongest company in our portfolio, we have today, we have over 500 companies in Europe, and the strongest company comes out of Romania. Imagine that. I mean, only less than 1% of our companies is in Romania, and it's a $7 billion valued company. It's UiPath. No one would have thought that UiPath could be created out of Romania. And I think we are playing this game. We think that the competition is much, much less for early stage in Europe compared to the US or Israel. And that's why we are focused on tech talent in Europe, and we will have a diversified portfolio over 5 vintages. And by that, I think we will come to that outliers, the power law thing, we will have those 1% to 2% outliers in our portfolio, which is more than enough to have a real return on our portfolio.
Ertan, thanks a lot to you. Now I see that our next speakers, we have to move forward to our next panel. Ertan, nice to meet you here. Yes, my pleasure. I want to say you goodbye. Yes, and now I see that our next panel is already here.
Thank you very much.